Investors getting ready for the last trading day of the week after the S&P did breach 5,000 for the first time. Looks like it's going to be there this morning on the open. Joining us now, Sarat Sethi, DCLA portfolio manager and a CNBC contributor. Sarat, you don't think the market is necessarily severely overvalued or undervalued? Kind of like it's sort of right where it is.
Yeah, and I think, you definitely have the pockets of overvaluation, and then you've got the other areas, the, small caps and some of the value stocks that haven't come back. But I definitely think there are opportunities in the market. You just have to be fairly diversified at this point. And Joe, credit is not bad either. I mean, spreads are really tight, so they're actually indicating to the market that they don't really see anything down the hatch that's going to make this market too shaky. Now, yeah, we have commercial real estate, but that seems to be pretty fairly discounted at this point.
So what are the pockets of where you're seeing some value remaining, where undervalued?
I would go to commodities, basic materials, look at companies like copper, steel, aluminum. And it's not a question of inflation. It's just a question of supply and demand. So a Freeport or a Tech Resources or a Cleveland Cliffs. Then I would look at the staples area. I mean, you look at, the beer companies or just some of the food companies that have pricing that actually are trading at below market multiples. And then I look at utilities, and utilities have just been hurt because rates are where they are, but their earnings growth, especially companies like AES or Edison, are 8 to 10%, trading at 12 times earnings. So you can put capital to work. It's just the market has favored growth so much that I think it's okay to be in other areas, and not to say you don't have to be in growth. You can be, but look at the other areas as well.
Why do you think the market shrugged off the pivot on the other pivot that we saw from the Fed, that rate cuts, it could be fewer and they could be later in the year than before? But you're looking at that chart right there. If someone told you that, you certainly can't see it from what we're looking at in the S&P.
Yeah, I think the market basically said, hey, listen, if the Fed is not going to cut rates now, it means that they're seeing a couple of things, which is that growth is still good. So if growth is still good, the longer we go, because we know most recessions are caused by the Fed acts either too early or acts too aggressively. So I think if earnings can still be strong, I think that's really good. And they're watching inflation. And I think that's going to be important. We saw the number today getting better for December. And I think you have that. And it's kind of that classic Fed put now, because if they see something and they're do it in time, I think that's going to help the market. But, if they went too early, then most investors would say, wait, there's something that we're really missing. So you're kind of in that sweet spot. So I think that's where valuations really matter at this point. And chasing kind of the leg that we had in the last 18 months, I think most of that party's over. So now you really have to say, how are we going to make money down the road? And I think earnings growth, cash flow is really important.
Think that there's anything that can happen between now and November that would really scare the markets? I don't know why the market's not scared already. I mean, as Americans, we're kind of scared at what's happening. Does the market ever sit up and take notice, or it really doesn't matter what Washington does?
Well, I think at this point, something out of left field will have to come, and you already look at what's going on geopolitically and with what's going on, in DC. So it would have to be something really out of left field. Oil's at 70, input prices coming down. So, but you could. I mean, look, in 2022, market dropped and then came back last year. So I think staying in the market, but understanding where you're invested, Joe, is going to be one of the most important things, I think, for the next probably 6 to 12 months.